I'm Greg Hunter. Welcome to USAWatchdog.com. With us, one of my guests, and one of the things he said to me a long time ago was this: you can only predict the end of the world one time, so I don't like to do that. So that's this is the kind of guy he is. He's a really facts numbers guy. He also said in one of the early interview or earlier part of this year, late last year, he said 2020 is going to be as good as 2010 for the gold market. It's going to all the metrics are lining up, and that gold is going to be great. But he also has some important information he's got for the gold market, and it finally getting into a situation where maybe it's going to become well known to the public that they just can't deliver the gold they say they can deliver. And with that long introduction I'll bring on Craig Hemke of tfmetalsreport.com. Craig Hemke, thanks for joining us today on USAWatchdog.com.
Greg, it's always a pleasure, my friend. And hey, just for everybody listening, you're always such a great promoter of my site, and it's always fun to come on your channel because it's so well respected. But as we've done in the past, I'll tag on a little discount to my site at the end for people
we'll talk about that
to take a look at it.
Well, let's talk about.
We'll do that at the end. But in the meantime, you're right. The old adage is you don't want to go around predicting the end of the world because you're only going to be right once. So we don't do much of that. And the second part of what you were adding. Remember we talked last year a lot about how 2019 was going to be a lot like 2010 with the Fed reversing course and the precious metals breaking out and moving higher. That's exactly what happened. And now we're waiting for this year to kind of turn out a little bit like 2011. And that seems to be happening too.
Let's start with the, opening up Pandora's box. Without getting way into the weeds, the mines are shut down, supply has been restricted, but demand is through the roof. And you're saying that it's looking like over at the CRIMEX, that's what people call it, as you know, the COMEX, that they're going to have some real hard times delivering actual physical gold, which is what they're supposed to do. It's a physical market. Tell me about just briefly about we're coming to some sort of epiphany that COMEX isn't going to be able to deliver the gold that they've always said they could deliver.
Well, at TF Metals Report, I've been doing this for 10 years. We've been talking about this the entire time, really. The COMEX market in New York is where they trade futures contracts. And the futures contracts, because of the way the system is set up, basically determine the physical price. It should be the other way around. A trading of the actual physical commodity should be determining price, where you give me an ounce of gold and I give you back cash. But instead, it's these trading of these futures contracts which determines price. And the futures contracts have to be backed by the physical commodity. Otherwise, you might as well be trading baseball cards. And that's basically what it has become. You're trading these derivatives, these baseball cards that have no connection to the physical metal at all, because every 2 months on COMEX, a contract matures, if you will, goes off the board and goes into its delivery phase. Well, in the past, these deliveries have been nothing but paper warrants and promissory notes and things like that, where one bank like JP Morgan delivers, or maybe I should give you some air quotes like people do, delivers metal to another bank like HSBC 1 month. And then the next month, 2 months later, HSB turns around and delivers it back to JP Morgan. And everybody says, see, look, there's delivery taking place there. Well, the problem is there wasn't. Okay, so there never has been. It's been this charade of delivery. Well, fast forward to about 2 weeks ago. And what began to happen was a delivery default. One of the inside baseball things, and I don't know if you and I have ever discussed or not, is a process that the exchange uses called exchange for physical.
That's it.
And basically what that means, that EFP, is that you can take your COMEX contract, which represents 100 ounces of future delivery, and exchange it for physical, allegedly. And that, that was done, I don't know, in London, sometimes they said, or maybe they'd use shares of the GLD, any kind of equivalent of physical was what the CME would allow, okay? So the abuse of this system was so great over the last several years. I wrote about it multiple times. It's brought money and other sites where I post regular articles. Well, let me give you this. In the first, I just want you to ponder this, Craig. In the first 20 days of March, okay, like 15 trading days, the total amount of COMEX contracts that were allegedly exchanged for physical metal was 290,000. Now, 100 ounces per contract is 29 million ounces. 29 million ounces is 900 metric tons of gold that were allegedly exchanged for physical. And I'm like throwing up the red flags. This is preposterous. Okay, so here's what happened. Thinking that this was a legitimate transaction, a few parties showed up and actually wanted physical metal. They said, well, the refineries are closed, the mints are closed, even the mines are shutting down. And I've got to, I need metal right now. So, hey, look, the COMEX is running this process of exchange for physical every day. Hey, I'm going to get me some. That's a great place to go get some. So they show up on Tuesday, March the 24th, demanding gold out of the COMEX. And the COMEX basically immediately defaulted. Didn't have it. Now, the apologists for the pricing scheme and shills and people that don't know any better because they're just generalists say, well, that gold was there. There's plenty of gold. LBMA came out and said, oh, we've got thousands of tons in our vaults. The gold's there, just in the wrong place. Right. Okay, whatever, fine. They've since amended the contract so that now they can deliver fractional ownership of bars in London. But at the end of the day, what this exposed was this lie of delivery where I began this comment. There were no 100-ounce bars. The COMEX allegedly had 8 million ounces worth of 100-ounce bars in their vaults. That's what the CME was telling us every day when they update their vault stocks. But when somebody actually showed up and said, no, I'd like some of that, they immediately said, whoa, sorry, we don't have any. Sorry, come back in a couple of weeks. Look, the system is a total fraud, okay? This pricing scheme was devised in 1974 as a way to diffuse supply, make supply appear more readily available by the creation of all these synthetic forms of gold like futures contracts and unallocated accounts. The reason they did that in 1974 was because in 1975, the day after futures trading began, the U.S. citizens were finally allowed after 42 years to own gold again. So they had to come up with something. And the system has just been bastardized and made worse in the 45 whatever years since. So now it's finally crumbling because people are figuring out that it's a scam, that it's all a confidence scheme, that you may think you own gold. The bank, whether UBS or JP Morgan or whatever may tell you own gold. But what you own is just a promise, just like it's a fraction. It's a fractional reserve scheme, just like your bank. You deposit money in your bank, but they don't hold the whole thing. They loan out most of it. You can't just show up and withdraw your money from a bank. Same thing with these big banks that run the gold market. And so now they're being called to the carpet to try to supply gold. And in a long answer to what was your just initial question, I apologize. The system is starting to fragment. And they'll probably keep it together. I mean, the mines will probably come back online, hopefully, before too long. The refiners will start pumping out gold again, and confidence will somehow be restored. But it has certainly been shaken. And when the day finally comes that this pricing scheme is shattered and 50 people show up to take possession of the same ounce of gold because 50 people have been promised that they have it, well, that's when the excrement hits the fan, my friend. And then we do finally find out what the price of gold is in a true physical exchange of an ounce of gold for however many dollars.
That's the other end of this trade was that, wow, you can give me an ounce of gold for $16.50? Holy cow, that's what it was like in 2010 or early 2011. I'll take that. And they know it's a fake price. Who wants to unload their real gold at a fake price?
Right. And nobody's doing it. And that's the thing. People are wising up to this.
Well, I mean, the guys that are holding it, surely they like, whoa, I'm not selling my multiple metric tons of gold for $16.50 or whatever it is right now in change. That's a fake price.
Or Greg, even at the retail level, I suppose most people watching us right now have, they've bought silver in the past, or they've thought about buying silver or gold, and they realize that all the dealers are either closed due to quarantine, or they're simply out of stock because the Royal Canadian Mint's closed, the US Mint is closed, and all this kind of stuff. So the only place you can go now, right this minute, to get kind of immediate delivery for physical gold or silver is a place like eBay. Now, notwithstanding whether you trust the seller and all that kind of stuff, but anybody can go to eBay and find, an ounce of gold for sale. And right now, you probably can't find one for anything less than $1,800 an ounce. Okay. Well, same goes for silver. You can't find it for less than about $24 or $25 an ounce.
Yeah.
So what's the real price? Is silver $15 an ounce as traded by these phony baloney derivative contracts that don't mean anything, that might as well be baseball cards? Or is it 25? And then when people talk about the gold silver ratio, is it 115 by the CNBC price that you see, the futures price? Or is it 75 by the eBay price? I mean, these are all questions that people are starting to ask. And every single one of those kind of chips away at the confidence scheme that the banks have run for 45 years in this precious metals markets. And that ultimately leads us towards physical pricing. And all I know is when that day comes, because that day is going to come, the price isn't going to be $1,700 an ounce for gold and $15 an ounce for silver.
Well, let's talk about what's making the stock market go up. I mean, one of the headlines was the stock market. This is on Monday. So the stock market up 1,600 in AI wackadoodle crazy times because people think there's actually people trading this market. There's not generally. They're up 1,700 points, another 500 points on Tuesday, yesterday, and now you're saying, oh, this is why you need to own gold. Explain.
Well, and look, I'm not a stockbroker anymore. I'm not a I was for 20 years. I had all my licenses and all that stuff. I don't anymore because I'm not affiliated with any firm, so I can't carry a license, and so I'm not able to give investment advice and all that kind of stuff. But what I can tell you is what my experience has taught me from watching this stuff since 2008, and that is the Federal Reserve, the U.S. government, the big banks, and all the rest, they cannot afford to have a stock market collapse because it wipes out liquidity. And then you trickle that down. I mean, the pension funds and the retirement plans and the 401ks and all this kind of stuff, they can't afford to go down. Okay, that's why, part of the reason, at least, why the Federal Reserve will always answer any drop in the stock market with a pump of cash. We saw it last year, for crying out loud. Greg, when stock market was struggling and all of a sudden this repo situation reared up in September, the Fed reduces, completely alters course toward trimming their balance sheet, turns on the QE by monetizing $60 billion of T-bills a month, opens these repo facilities, all this cash floods the system. And from October the 11th to February the 11th, all the stock market did was go straight up. Okay, so here we now, let's fast forward to present day. The stock market's going in the tank, all this virus, and the economy shutting down and people getting laid off and all this stuff. But yet, now, as we record this, 12 days since this QE to infinity program was begun, back on Monday, the 23rd of March, I think is the right day, the S&P's up something like 17%. Well, wait a second. All these people are out of work, and all the unemployment and all. And even if we do come back from the virus, we're probably still looking at double-digit unemployment for, quarters and quarters to come, and businesses that are never going to come back because they're living hand to mouth and all that kind of stuff. And that's all true. Fundamentally, that's all terrible stuff. But that doesn't mean the stock market's going to go down because all of this cash that's being created ends up going into the stock market and everything else. So when I tell you that the stock market's up 17% in the last 12 days, it should also be no surprise that gold's up about 14% and silver's up 25% in the last 14 days. And that is going to continue. Not straight up, but it will continue. And so, I mean, people need to understand how these markets actually operate and what actually drives them so that you stay engaged, be aware of what's happening, and then, kind of position yourself accordingly.
It's so... This is the perpetual circle of we got to keep the stock market up, we got to print money, and the people watching this go, oh my gosh, We got to buy gold, got to buy silver, got to keep the stock market going, got to keep going. Oh my gosh, they're going to do some more.
Yeah.
Got to buy gold, got to buy gold. So the demand situation is going to increase for physical.
Mm-hmm. Yes.
So
And
you're going to
see,
get this thing. So you have a self-perpetuating fuse lit on a time bomb where the demand is going to increase exponentially as the money printing increases
right,
exponentially. It
right,
means the price is going to increase exponentially.
right. And see, and that eventually is what causes the problem for the banks that run the pricing scheme and have run it since 1974. Because they've created all of this synthetic gold, all this pretend gold, all these unallocated accounts and futures contracts and promissory notes and all this other stuff. And it's based upon a limited amount of physical supply. So as physical demand ramps up and people demand physical holding, they don't want it to keep it in the system. They want it themselves. That forces a deleveraging of that, or amps up the leveraging, but eventually forces a deleveraging and collapse of it. And that's, what we talked about in the first part of this segment. But in the end, this demand for gold and silver in all their forms, meaning mining shares as well, is only going to continue to increase. And in the West, we don't want things on sale, right? People are always selling at the lows. They're not buying at the lows. So as price goes up, people want it more, right? That's kind of the perverse way that we do. That's not how they do things in India and China, but that's how we do things in the West. And so as price goes up, people are going to see it moving and demand more of it. And what eventually happens is just math. I mean, for now, maybe 1% of the total global asset allocation is to precious metals and mining shares and things like that. I mean, it peaked at 8 or 9% back in 1980, bottomed out less than 1% a couple of years ago, and it's still only 1% now. Well, what if it goes to 2%? What if it goes to 3%? I mean, it doesn't seem like much, but when we're talking trillions and trillions of dollars being led into a sector,
and euros and yen and
yeah, and that sector, Greg, that sector has a finite amount of investment opportunities. There's only so many mining companies, right? There's only so many junior mining companies. There's only so much physical gold and silver price response. And so it's not something, and I've never told people, because I can't, that you should cash out every dollar you got and put it in gold and silver, and head for the hills and that kind of stuff. But man, it is definitely a part of a balanced,
core,
prudent portfolio. And as more people realize that, more dollars comes in and it forces higher prices. And look, I'm not like I'm, splitting atoms here. I mean, this is not really that complicated.
You got Von Greyer's. I mean, this is not investment advice, but I just say, he vaults gold for billionaires on 2 continents. And I said, so what do people have? He goes, what do your, rich players have? He goes, at least 20%, some 50%. I said, so you got people that have $1 billion. Oh, yeah. And they have at least $200 million in vaulted gold. Oh, yeah. That's not investment advice. That's just what, the wealthy are doing. And he said, we know how this ends. But here's my question to you. I want to keep going. Everybody thinks that we can just print money to infinity, and yet you have Fitch ratings saying, we're going to cut your ratings if you keep doing this. And then you have, Ben Bernanke, or was it Greenspan, was warning of, I think it was Greenspan, warning of a couple of years back of a sudden spike in interest rates. I mean, if we keep printing, funny money, isn't the bond market gonna fall on its head?
No.
Because
the Fed will always be the buyer of last resort.
At some point, is it a dollar? I mean, how is the world going to watch us print trillions of dollars and go, oh, great. Sure, you could give me your dollars for this barrel of oil and for this electronic product. How in the world does the rest of the world keep watching us print crazy, vast amounts of money, and then we just keep buying their stuff for, confetti?
Because, well, Greg, for now, the rest of the world's doing the same thing. And so if the dollar, the euro, the yen, the Swiss franc, the pound, you name it, we're all falling down the same elevator shaft together, relative to each other, they're all staying about the same value. You see what I mean? But in absolute terms, they've created so much of it that it makes all of these other assets that are priced in those currencies go up in value. And that's why gold and you name it, since QE, have gone up. But anyway, there is. You'd like to think there's a limit, right? But there really isn't. I mean, I'm sure you probably watch 60 Minutes every Sunday night like I do.
No,
And
you know what? I hate to say this, but they're fake news.
oh, okay,
They
well,
are. They are fake news.
I
I
sometimes
worked in those houses. They're fake news.
that's true.
I mean, I'm
you know
sorry, they
better
are
than
fake
I.
news. I mean, you have what Oprah as a correspondent. You have
Right.
Anderson Cooper, who was an
Anderson
intern for the
Cooper,
CIA for a
Sports
couple of
Illustrated
summers.
guy. No, and you know better than I. But 2 weeks ago, the night before the Sunday night, whatever it is, I'm just trying to do the math and in account to it, the 22nd of March, I guess, my sister's birthday. Anyway, Neil Kashkari, the head of the Minneapolis Fed, was interviewed by the Scott Pelley guy, I think.
Yeah.
And Pelley asked him straight up. He said, "Well, is there any limit to how much cash you can create?" And he said, "No, it's infinite." I mean, anybody can look this up. I mean, he said this on national TV. Excuse me. So, the very next day, he was just plowing the field. The very next day, before the market opened, March 23rd, as we talked about it, that's when QE to infinity announced. The Fed just basically said there's no limits to the amount of U.S. debt that they are going to monetize. And now, again, think of how much they're going to have to do. Greg, when we last spoke, I'm confident that we discussed what the U.S. budget deficit was going to be in 2020, because when we last spoke, I was basically having this conversation with everybody. The Congressional Budget Office had come out at the end of last year. Now, remember, the U.S. fiscal year begins on October 1st every year. They came out at the end of last year, right around the holidays, with a report that said the U.S. government was going to run a fiscal deficit of $1.2 trillion a year on average for this entire decade. Now, they did that with a base assumption of 3% economic growth, which we all know is crazy. We haven't done 3% GDP growth for maybe, a decade? But anyway, they cook in 3% so that they can cook in an ever-increasing stream of tax revenues, because that's the only way the government makes money, right? Taxes and fees and stuff like that. So if the economy contracts, the tax revenue to the government falls and your deficit widens. So we were already in the U.S. projected $1.2 trillion this year, okay? Let's just say roughly that was $4.2 trillion in spending and $3 trillion in tax revenues. Well, now this virus thing and all the businesses shutting down completely blows that apart. So now let's just say maybe the U.S. government only takes in $2 trillion this year in tax revenue. Well, now you got a $2.2 trillion deficit that somehow we got to come up with cash for. But no, it's worse than that. Now we've spent $2.1 trillion, which we had to do. I'm all fine. I'm all for. We got to give money to, to everybody that's out of work. Okay, now we're at $4.3 trillion.
Wow.
But now they got to do more stuff. The actual deficit this year is probably going to be more like $6 trillion. It was $24 trillion or so coming out of last year. So we're going to increase the total debt by 25% this year alone. That money's got to come from somewhere. Nobody's loaning it to us. The dollars in creation are actually getting vaporized because everything's going down. So these central banks, including the Fed, have to just simply create more. That's called monetizing the debt, which is what they will always do, which they just admitted they're going to do 2 weeks ago, to an infinite amount, unlimited, whatever they got to do to keep the plate spinning. And that's what's going to happen. And eventually all that money, once things stabilize, and we will stabilize, and we'll come out the other end of this, all of that cash gets created, gets flooded out into the markets. Now, in 2011, myself included, was wrong about hyperinflation and stuff because I thought all this cash that they created in those QE programs was going to come flooding out. It didn't, because what the Fed did is they mainly bought garbage bonds, just totally worthless things from their banks like JP Morgan and Citi and the rest. Even paid a premium for some of that stuff. That stuff might have been worth $5 or 5 cents on the dollar, and they paid $1.05 for it in corporate welfare to the banks. The banks then turned around, and rather than loaning it out, they took their $2 trillion and just simply parked it at the Federal Reserve in what's called excess reserves, and then made interest off of it. So that money in itself, to use current parlance, was in quarantine and never got flushed out of the system and never led to hyperinflation. And eventually the steam was taken out of the precious metals and all commodities and all that kind of stuff. Well, this time is going to be different because it's not all getting quarantined.
That's right.
And so hyperinflation maybe not hyperinflation, but serious price inflation will be coming. So let me just circle back. I know it's been a long answer, but let me circle back to gold because we were talking about.
Well, hold on a minute. Hold on. Just serious pricing. I mean, listen, right now, John Williams says we really have a 10% inflation rate. I mean,
Yeah.
overall. I mean, Jack Catherine also Fitz says, well, if you get granularly, it's 8% here in Tennessee where I am. And, in San Francisco, it's 14%. Oh, okay, so it's 10%. So, you don't need hyperinflation to destroy poor people who are living paycheck to
Right. We're
paycheck
already
at
living.
70%.
Exactly.
20% would probably just wipe them out in short order.
Mm-hmm.
So go
Mm-hmm.
ahead.
Well, okay. So, but as I relate this back to gold, and we're talking about how last year was like 2010, and now everybody's waiting for this year to be like 2011. And when I first put out my forecast this year, I said we got to go through 1550 on a weekly basis, and once we do that, we'll go to 1650, and that's exactly what has happened. My target, though, for this year was only about 1750 or 1800. That may still be the case, but what will eventually shoot it catapulting higher to new all-time highs. And once we have new all-time highs, well, then the floodgates open because people go crazy because they think, oh, it's a new all-time highs. I got to have more. What will do that is inflation. And what I mean by that is a key driver of big money, institutions, hedge funds, and the like, a key driver of their gold demand is what we call negative real interest rates. What's a real interest rate? A real interest rate is inflation adjusted interest rates. Well, what does that mean? Well, if a 10-year treasury note is paying you 2%, but the inflation rate is 3%, that is a negative 1% return adjusted for inflation. You see what I mean?
Yeah.
Negative real rates is what drives these institutions demanding gold. Right now, because we're still in the contraction phase, right? We're in a deflationary phase with the markets going down and everybody being out of work and all that kind of stuff. So even with the 10-year treasury note yielding just 0.75%, interest rates are positive. Real interest rates are positive. Okay. But once this inflation picks up, and it was the fear of the inflation picking up in 2011 when gold went from 1100 to 1900. Once inflation actually begins to pick up, and that'll be a function of when we all get back to work, whether later this summer or this fall, that's when real rates either go negative or going in anticipation of going negative. Demand for gold in all its forms at the institutional level really takes off, and that's when we blast to the new all-time highs. We go through all the other foreign currencies are already there. The dollar-based gold is the only one that hasn't made new all-time highs yet. It will, and when it does, it'll probably go to 2,500 real quick after that. So the point of this then is, even though you can't get your hands on any, you might as well queue up, because the idea, that some are putting out there, oh, gold's going back to 1,200, or, it's these dopey economists that think it's going to 700. It's not, okay? The central banks will always print as much cash as needed to avoid some type of deflationary spiral. You'll instead get an inflationary spiral. Currencies will be devalued, and gold and silver will go higher.
But I still, and I'm not arguing with you because I think you're a smart guy and smarter than me, but I still don't understand how they keep a lid on interest rates. And if they do print money to keep interest rates down, then the dollar is going to get creamed, right? I mean, it ain't going to be 100 on the Dixie. It's going to be 50. It's going to be
Greg, two things. You're citing the dollar index. Well, what's a dollar index? It's the U.S. dollar versus a basket of 5 or 6 other currencies. Well, if those 6 other currencies devalue just as fast as the dollar, what's the relative change? None.
Yeah.
Okay. Then back to bond prices. The interest rate is a function of the price of the bond. Okay. The price of the bond is a function of whether there are more buyers or sellers. If there's a lot of sellers, then the price of the bond is going to fall and interest rates are going to go up. But the math, the way the function of it is, if the Fed is always going to be the buyer of last resort, if the Fed is always going to be on the bid, if the Fed is going to create as much cash as needed to absorb all of this treasury issuance, then prices of bonds aren't going to fall. They're going to rise. And rising bond prices mean lower interest rates. So yeah, it makes all the sense in the world. You'd think, yeah, interest rates have to go up because of inflation, or they have to go up high enough to reach a point where people actually want to buy those bonds. They think that, okay, 8%, that's a good number, basis inflation and the risks involved. Okay, I'll take 8% for 5 years or 10 years. Okay, that's how it used to work. but not in 2020, man. This is a whole different deal. When I first got my stockbroker license in 1990, it worked that way. That's how the stock market, you'd have buyers and sellers. Mom and pop would think that Walmart was their earnings were going to get better because, they were expanding. So buy me some Walmart. That's what the stock market used to be. But none of that even matters anymore. None of that matters anymore.
Totally.
The machines do all the trading. They take all this phony baloney created money, and it all just floods into these things. And that's why they go up. That's why bond prices go up. And that's why interest rates won't go down like you would naturally have expect or had been taught.
Interest rates won't go up, you mean?
I'm sorry, interest rates won't go. I'm sorry.
Well,
yes,
interest rates. So you don't think real estate will fall out of bed even with all the defaults? I mean, they're talking about with all this unemployment, they're talking about 30% of all mortgages are going to default.
Greg, that's a local issue, right? In general,
what about all the? Do you
yeah.
think Dick's is going to open up? I don't. Do you think? I hope they do. All those people. Well, actually, I hate the CEO. He's a weasel. But do you think JCPenney's is going to open up? Do you think? Macy's is going to open up? That's a big maybe. Do you think Sears is going to open up again?
Right.
Do you think? A lot of these places are going to open up.
There's an element here, one, of what's called creative destruction. Other avenues of acquiring goods will widen. Maybe just make Amazon more powerful. Not even going into whether or not that's a good thing. But there will always be avenues for things to get done. So if Sears goes out of business, somebody else, which they already have, somebody else will. If one bar in your local town, bar and restaurant, was so overly leveraged that they can't survive through this, somebody else is going to go in there, buy everything at 25 cents on the dollar, all the equipment, and they're going to restart a new bar. So I don't think, like we began this with, you don't go around predicting the end of the world because you're only going to be right once. And I would imagine one way or the other, we're not going to go back to normal, right? We're not going to go back to a 3% employment rate or something like that. The impacts of this are going to be long lasting. But I would not at all be surprised to see the Fed just simply create all the cash that's needed to keep the government operating and keep people with unemployment benefits and everything else. They'll create enough cash to keep interest rates low so that mortgage markets keeps on going and people keep buying houses and refinancing and all that kind of stuff. They'll keep that all low enough that the banks at the net interest margin can continue to make a profit and everything else. Stock market will go back up, so everyone will feel better about their 401k and their chances of retiring. It doesn't have anything to do with fundamentals. It'll just go back up and everybody will feel better. The pension funds will all be rescued, because now all of a sudden they can't have the bond market collapse and they can't have the stock market collapse, and they'll somehow be rescued with all this phony money. That's what I suspect will happen. Maybe I'll be dead wrong, and we'll all be dead 6 months from now, and it won't matter. But that's how I suspect it'll all play out in the end. And we'll probably, by the next time you and I speak, we'll see a lot of the signs of that happening.
We might get, we might get a 50,000 Dow, and we might get a 15,000 gold.
Yeah, Greg, the last couple of years, which have been the best stock markets in the whole world? Venezuela, Zimbabwe, places like that. Where in hyperinflation, they're just printing all this worthless cash, and it all just keeps bidding up share prices. It's not to that same extent, obviously, here, but the same thing will likely happen. Look, like I said, I'm not telling people to blindly go rushing out and buy some Vanguard index fund. And there may be losses before. We may go back down before going up. But there's just too much on the line for policy, the politicians and the bankers to let the thing just collapse.
So inflation or die, I'm going to live.
Yeah. There's a reason why the Fed says, they have this mandate of 2% inflation every year. Why? Because you've got to constantly be creating more money to service all your existing debts. That's what this system is. And now we're just getting kind of the exponential phase of it, just like the COVID virus is now finally getting to the exponential phase, and people understand how that works. There was a guy, the father of modern statistics, who said that's the greatest failure of the human mind is to not be able to understand exponential growth, the exponential function. Well, we're all getting a bad lesson in it, understanding how this virus spreads. Well, what people are now figuring out is the same thing as with debt. It's growing exponentially, which means the cash needed to service that debt grows exponentially. And then it's up to the individual then to just kind of be smart enough to figure out from there how to prepare accordingly.
And with the exponential growth of debt, we're right back to the thing that cannot grow exponentially, and that's physical gold and silver.
Right, right, right. They try.
The price can grow
right?
exponentially, but the supply cannot.
Right, right. And the system, the pricing scheme has grown it exponentially. Okay. I mean, we tried to control the price at $35 an ounce from the end of World War II all the way to 1968.
Yep, gold.
And finally, there was so much cash that was convertible into gold that the gold was running out. And the U.S. was losing all its reserves. And so they said, well, we can't do that anymore. And then from 68 to 71, that demand continued to the point where Nixon finally said, we can't allow you to convert gold into dollars anymore, dollars into gold. So then the price really starts to take off. And then the U.S. wants to have ownership again. And so then they came up with actual alchemy. They convinced the world that futures contracts and promissory notes and unallocated accounts is all good as gold. And then they came up with things like the GLD. Oh, it's as good as gold. You got gold, you got the GLD. No, you don't. You have exposure to the price, but you don't own gold. That's just not how it works, man. You don't own jack. So they've convinced people, though, that all these alternatives are just as good. Well, there's only so much supply
And now we're
underpinning that system. And what we're moving toward, and where we began this conversation, is a crisis of confidence in that supply. Now, maybe it's because of this temporary phenomenon of the miners being closed and all that kind of stuff. But people are figuring out how this works. And boy, we may just move up gradually, toward 1900, and then gradually, and I say gradually over a period of months. I'm sorry, I keep itching my nose. It's allergy season. To 2500 something. It may be orderly, but there will be a time when it will be disorderly. And either governments and central banks just have formally revalue gold from $35 an ounce to like 10,000, or the whole system breaks. And we immediately revert back to straight up, here's an ounce of gold for how much cash you're willing to give me for it. And again, that price isn't $1,700 an ounce. You're seeing that already on eBay.
Yeah. Your website, it's TF Metals Report, and you kind of built a community there, and you get all this your stuff that you do, which is great. And then you also have some very smart people on your website, and you charge a fee, and you cut out all the trolls, which I like.
Yeah.
I have a lot of trolls. Oh my gosh, they just pay to get on. Anyway,
which is useless.
They're just trolls. I mean, if somebody, people are like, well, you hurt my First Amendment. Well, let's say something meaningful. Say something somebody can get. Don't be a paid troll. Anyway, you don't have paid troll. Tell me about TF Metals Report and what you do and what you're offering.
All right. Well, we've been
doing
this
incidentally, I don't get paid anything for this.
And I appreciate that.
So
and
go ahead.
I mean, you're just a friend, and I
like what you do, and I want to tell people what you do. But you don't pay me for this. But anyway, I just want people to know that we're not in business. Although I like you and I trust you, but we're just not in business. Okay, go ahead.
The site tfmetalsreport.com. The greatest value is the community of people from around the world that we're all from around the world, different political stripes. It's not all Trump supporters. It's not all Trump haters. It's just everybody's got their individual background, but we recognize we're all in the same boat financially. And so one of the great values of the site is the community itself. I also do my analysis of all this stuff, like what we've been talking about for the last whatever it's been. I do it every day with a post in the morning and a podcast in the afternoon, and we bring on guests during the week and all this kind of. It's $12 a month. All right. So it's not like it's $100 a month or something outrageous. It's 40 cents a day. I mentioned earlier a coupon code. We've done this before, Greg, and there's always a nice chunk of people that come over and sign up and kick the tires. If you go to tfmetalsreport.com, you click the subscribe button, you'll find out how a subscription works. A monthly subscription is $12. You go to checkout with a monthly, so not an annual, but a monthly subscription. And you enter the coupon code. We'll just make it Hunter, like we've done in the past. You type in the word Hunter, Hunter. You get 50% off your first month. Okay, so it'll save you $6 and make it 20 cents a day, so you can see what it's like. You can cancel at any time. I mean, it's not like I'm gonna hold you hostage. But if you don't cancel, like any other subscription, it'll start to renew every month at the $12 a month fee. after your first month is up. But at least gives people, it seems to work. People want to save $6 to find out, if it's worth it. So come to tfmetallsreport.com, hit the subscribe button, buy yourself a monthly subscription, enter the coupon code Hunter. You'll be charged $5.97. You get to see what we do for a month, and then it's up to you if you want to continue.
Craig Hemke, I appreciate you coming on and telling us how the world's not going to end, but it sure is going to get some inflation.
Oh, jeez.
And I really appreciate you coming on. I appreciate the analysis and level-headed analysis. But, listen, for somebody on the fringe just barely making it, I mean, you get 10, 20, you already have 10 roughly, according to John Williams. You get 20, 30% inflation. You don't have to have hyperinflation.
I shouldn't be smiling and laughing. Look, Greg, you're old enough. I'm old enough. You remember what it was like in the 70s, right? Yeah.
I remember this in the 70s. I'm lucky to have a job. Remember that?
Right.
Remember that?
Whip inflation now, the national plays.
Yeah, I had buttons at my buttons.
Yeah, that's where we're headed. I've been telling friends and stuff. You and I again are old enough, and a lot of people watching us are old enough to remember, like a pre 9/11, post 9/11, right?
Yeah.
Post 9/11, we're all taking our shoes off in the airport, and we got to deal with the Patriot Act and all this other jazz. But we remember what it was like prior to that in the 90s and the 80s. Unfortunately, I'm afraid we're all going to look back and remember a pre-2020, post-2020. I mean, that's kind of how it's setting up.
I think so. I think you're right. Craig Hemke, thanks for joining us today on USA Watchdog. Craig Hemke of tfmetallsreport.com. Thank you very much, Craig, and we'll have you on sooner than later. Thanks a lot for being on usawatchdog.com.
All the best, my friend. Thanks for doing what you do, too.